And now to our first conversation as Nigeria looks ahead to 2025. Its macroeconomic landscape presents a complex mix of challenges and opportunities. We see the country navigating a delicate balance between managing inflation, stabilizing the Naira, and fostering sustainable growth in the face of global economic uncertainty. But let's get an outlook now with Basil Abia, the co-founder VerivAfrica, joining me from our Abuja studio. Great to have you on the show.
It's great to be here.
It's good to have you, Basil. So you recently released your rest of 2024, first quarter 2025 macroeconomic outlook. Tell me, what is your crystal ball saying?
Well, we haven't released it yet. We're releasing it today at 1 p.m. We have an event. I won't disclose the physical event, but there's a webinar, of course, and it's free for access for people who want to register and listen in. But our crystal ball is in three ways. We're looking at the best case scenario, we're looking at the base case scenario, and we're also looking at the worst case scenario. For the best case scenario, we're looking at GDP growth, real growth rate to be at 3.65%. That will be largely driven by the services sector. Of course, that cannot translate into more jobs growth that we would be expecting. So sort of cautious optimism in that regard. Inflation rate would be around 31.1% on aggregate. As you do know, of course, there's an expectant that the aggregate inflation rate for 2024 when it ends will be at 32%. And there are a number of factors driving that best case scenario approach or projection for the Nigerian macroeconomy. Of course, one assumption is that the Dangote refinery will be able to supply as much energy, especially with PMS and diesel, as well as aviation fuel, to boost logistics, especially in the rail sector. We also expect that at best, we will have $90 to a barrel in the international oil prices. So these are the assumptions that are driving our best case scenario. For the base case scenario, we're looking at inflation rate at 34%. We're looking at real GDP growth rate at 3.4% for 2025. And then we're looking at a very minuscule money supply growth rate at 2.5%. And then for the worst case scenario, this is where it gets really worrying for Nigerians. And I'm sure Nigerians don't want to hear that, but we're estimating that the dollar is going to go for at least 2,000 Naira for most parts of 2025. That is also going to see inflation rate at the highest level, should be about 37.7%. And then, of course, GDP real growth rate would slow down to 2.9%. There are many other numbers that folks will be able to see. We're going to have our microsite out by 1 p.m. If you visit our website, VerivAfrica.com, you'll be able to see it, our socials as well. We have all the infographics that you need, all the assumptions that you need, from exogenous shocks to, of course, our structural deficits that are bedeviling our ability to be able to grow at the rate that we should be growing, which I think should be 7% and above.
Okay, Basil, but definitely that outlook for the Naira trade against the dollar, straight dagger to my heart, 2,000. I don't want to see that. But, we have a bear case scenario, we have a bull case scenario, we have a base case scenario. So I'm looking at inflation. You're saying the bull case, 31.81%. I love the bull case here. For GDP growth, you're saying 3.64% there. And 1,370 Naira to the dollar, that's the bull case. That's the bull case you're seeing. So tell me, what do we start doing now to actually achieve the bull case scenario for these macroeconomic data?
First, the federal government in Nigeria has to do everything possible to arrest the insecurity in most parts of the country. As you do know, of course, the insecurity dynamic is multifaceted. At least 5 of the 6 geopolitical zones are bedeviled with a form of insecurity that is, of course, perpetrated by non-state violent actors. We, of course, can now confirm, of course, last week that a new transnational terrorist group, the Lukarawa, just joined in, and we're already seeing fatality rates. I think about 15 people have died now in Kebbi, based on the open source reports that we're seeing. So federal government has to take on its constitutional responsibility, which is ensuring that we defend our territorial integrity, also ensuring that lives and properties are safeguarded. That will enable more mining activity that we're seeing. We're seeing an increase in artisanal mining that can demonstrate some growth, not real-time growth in that sense, but also services. For services that we are also projecting would improve that growth for the bull case. We believe that one of the reasons why the services industry will push growth is for two reasons. Dangote refinery, the assumption is that Dangote refinery will be able to supply as much logistical support with its energy supplies, if we can obviously curtail some of the cartelist behavior that we're currently seeing in the downstream petroleum sector. And then secondly, we're able to see energy production ramped up. So we want to see the Siemens project, the Presidential Power Initiative, reach its 100% implementation rate. It's currently doing just slightly below 50%. And that's delivering all of the transformers and all of the transmission infrastructure it should be able to deliver for phase 1, so that we can move to phase 2. We're also expecting that hopefully we're able to get the 1,250 megawatts power plant in Ondo State from Pacific Energy online and on grid. I don't think that the grid can take in that much right now, so we're praying that the Siemens project increases the transmission capacity so that we're not having downsides like we do have. This year has been terrible in terms of that. We've had 12 to 13 power grid collapses. Based on your sources, of course. I know that there are some sources like Naira who are saying it's just 10 collapses, but if you do the calculations, averagely 12 grid collapses. And then let's not forget, we had an entire section of the country, northern Nigeria, 17 northern Nigerian states without electricity for 12 days. Productive hubs like Kano, I can share personal anecdotal stories. I was talking to an FMCG plant manager 2 weeks ago, and when he was showing me their diesel bill, about 10 million naira they spend on diesel every day. That's not sustainable. That increases the inflationary pressure that we're currently witnessing. So for us to have the services sector push that growth, we'll be able to ensure that energy production is ramped up. Another thing as well that is very important is we want to get our manufacturing base back on track. They are currently going through the worst. I'm sure you've all read the CBN monitor right now, performance monitor, when it comes to the manufacturing industry, and it's terrible, from 17.5% index to about 14.5% index. And you can do the numbers. Even Manufacturing Association of Nigeria released their damning report on 2023 on sold inventories of about 350 billion naira. If I'm not mistaken as well, over 700 manufacturing concerns or manufacturing firms had to close down fully. Losses of jobs and tax revenue, of course, that's leading. We have not even seen the 2024 report from the Manufacturing Association of Nigeria. And if you even just ask folks who are your friends who work for manufacturing firms, the story is the same. So structurally, we need to be able to look at how we can arrest all of these structural deficits. It's not going to be possible in 12 months, but once you start to see progress, for instance, like the Presidential Power Initiative delivering on 100% implementation rate, we try to make sure that many of our private concerns in the generating the value chain for electricity also are able to ensure that their plants are online and on grid. That will increase electricity supply. Our transmission capabilities to handle that inflow of energy will also be able to increase. And of course, as you do know, in productivity sides, the increase in energy correlates directly to increase in productivity. So that's how we're going to be able to get our bull case. It has to start from the federal government. They have to govern. They have to ensure that insecurity is stemmed. It's just the truth. Govern, and govern well.
Government. Thank you so much for that, Basil. But, definitely looking at the PMI, looking at the household expectations, business expectation data, definitely not cute, data at this point. But let's talk about interest rates now. What are you seeing for interest rates? We know the central bank is still, trying to rein in inflation, at this time. Are we seeing more hikes, going forward, or is the central bank running out of wiggle room when it comes to interest rate hikes?
For our bull case, if you read it, of course, when it's out, we are expected to see at least 100 basis points increase, or a rate of increase of 100% when it comes to monetary supply rate. It's a monetary policy rate. And it's indicative of the fact because our money supply rate is super high. And it translates, of course, to exchange rate pass-through when it comes to inflation. As we do know, there are certain concerns by folks in the financial space who, I don't share this idea, but it's an idea that's already out there. Whenever FAC allocation money is spread allocated to state governments. State governments start to mop up scarce dollar in the informal dollar market, and that raises pressure on the exchange rate. And of course, as you do know, exchange rate has direct pass-through, especially when it comes to imported goods, and we have a very high import bill rate. So we should be able to see 100 basis points increase, or 100% rating increase in MPR, and I'm looking at close to, sorry, I said the 100 basis points, 100% rating increase in MPR. So that is something around 54% interest rate hikes for us to be able to reach our bull case scenario. Right. And then there's also another argument, again, very important to highlight, that we allow for multiplicity of thoughts at VerivAfrica. And there's an argument on one side of the team that believes that we should be able to manage our monetary supply, money policy rate well. And by that, it means introducing the tiered CRR regime, where you look at certain banks who have very good or very healthy non-performance loan ratios. And then they also have very good loan-to-deposit ratios. I know of certain banks that already have 40%, and I know of, in fact, the bank that I bank with currently doing an abysmal number of about 16%. We need to be able to, I'll tell them off when I get the chance to. But what I'm basically trying to say is, if you do the tiered CRR, the argument from half of my team is, if you do the tiered cash reserve ratio, what you're able to do is that you reward good performance with MPL, good performance with loan deposit ratio, and give them more leverage to be able to provide more credit to the real sector. And for those who are bad performing, you further punish them. So basically kind of using incentives to drive credit supply to the real sector who are in need of it. If you read the performance monitor by Central Bank, and you read the data from the Manufacturers Association of Nigeria, one of the core things these business managers are almost always highlighted is the fact that credit is super expensive. So if you can manage that monetary policy rate in a very innovative way, introduce it. I'm not oblivious of the fact that Governor Emefiele had done something close to that, but we all know the money supply influx was something we cannot really describe, you know. So,
all right, Basil, so much.
The central bank monetization to the federal government was obscenely high, and that was the reason for the money supply growth.
All right, thank you so much, Basil. So much to unpack there. You know, definitely a very interesting report there out of VerivAfrica. But thank you so much, Basil. It was great having your perspective today. Basil Abia, co-founder, VerivAfrica. Thank you for sharing your crystal ball with me. Thank you.
Thank you very much, Laddie. Pleasure to be here.
All right, we'll take a break now. When we come back, well, we get a check on what stocks might profit from this presidential committee fiscal policy tax reform bill. That's the moment to stay with us.